So this is the most important video you will ever watch if you are a professional stock market trader or an investor. I like to keep things simple. That is why I just have one slide for you for this video, but I'm going to discuss this in great detail. I'm going to discuss each of these points in great detail. This is like a formula that I'm giving to you in terms of improving your stock picking skills. If you just follow this, it will dramatically improve your results. So let us look at what we have on this slide. So as we all know, there are two types of trading. I'm only talking stocks here, okay, because I am a stock market trader. There are two types of trading. One is swing trading, one is positional trading. For swing trading, your ideal holding period could be 1 or 2 months, not more than that. Sometimes it is just 1 or 2 weeks where you get double digit return. Let's say in a couple of weeks, you make a return from between 10% and 40%. Okay, it is possible. That's swing trading. You come out, you buy quickly, you come out quickly, you book your gains, and then you compound those gains. That is called as swing trading. Then you have position-based trading, positional trading, where you buy a stock and then you hold on to it for 6 months, 1 year, 1.5 year, 2 years, maybe 3 years. But as the stock continues to go up, as it forms multiple bases, you buy more as the stock goes up. You start pyramiding, you start scaling into the stock, and you also sell. You also book some profits along the way as the stock begins to go up. Okay, that's called positional trading. Basically, positional trading is where as long as the stock remains above the 50-day simple moving average, okay, that's that's a stock that would be categorized as something that you have taken a position on and you want to stay in that stock for a very long period of time. That's called positional trading. Now, what is the criteria that we should look for before we decide whether we want to swing trade a stock or whether we want to do positional trading in a stock? So I have written the formula for you here. Focus on the best stocks from the best industries and in confirmed stage 2 uptrends, forming tight bases on the right side near their 52-week high. Now that's a lot. There is a lot in that statement. Okay, I want to define each and everything that I have mentioned in that statement. Once you understand the definition, you will understand the importance of this video. Okay. Number one, what do I mean by best stocks? Best stocks means stocks that have a relative strength of 80 or more, which means stocks that are in the top 20 percentile of the market in terms of their 52-week performance. Okay. So that is called best stocks. Stocks with relative strength ranking of 80 or higher. Within that group, okay, stocks which have a relative strength of 90 or higher, those are called as the best of the best. I call them the best of the best stocks. So remember, relative strength between 80 and 90 are called as the best stocks, and relative strength more than 90 is best of the best stocks. Okay, so focus on the best stocks. A relative strength minimum 80 or more than 80. If it is more than 90, it is like icing on the cake. Okay. Number two, focus on the best industries. Again, the top 20 percentile of the industry groups. There are total 197 industry groups. So focus on the top 40 industry groups as per MarketSmith ratings. Okay. Or if you don't have MarketSmith, just look at the performance of all the industries. Focus on the top 20% of the best performing, top 20% best performing industry groups. So if you look at the 6-month performance of each industry and you sort all the industries and you take the top 20 percentile, okay, those are called as the best industry groups. So whatever stock you select, it should be in from that industry group. Okay. So it's a very specific definition. These two definitions are extremely specific definitions. Okay. Now, third, and in confirmed up stage 2 uptrend, the stock that you choose to buy should be in a confirmed stage 2 uptrend. What is the meaning of stage 2 uptrend? the price should be above the 50-day simple moving average. The 50-day simple moving average should be above the 150-day simple moving average. The 150-day simple moving average should be above the 200-day simple moving average. That is the specific definition of a stage 2 stock. Okay. Sometimes the 150-day moving average criteria could be compromised. So as long as the price is above the 50-day and the 50-day is above the 200-day and both the moving averages are sloping up, I would still consider that stock as a stage 2 uptrending stock. But again, the best of the best stage 2 uptrends have this lineup: price, 50-day, 150-day, 200-day. That's the best of the best. The best stage 2 are price, 50-day, 200-day. I'm not looking at 150-day. Okay. So the pure stage 2 uptrends have the price above the 50-day, the 50-day above the 150-day simple moving average, and the 150-day above the 200-day simple moving average. So these three definitions are extremely specific definitions. Okay. And I have created a filter for this on MarketSmith, which I have discussed in some other video. Okay, you can watch that video. You will find that video in my playlist called Stock Filters. I don't know exactly what is the name of the video, but you will find it there. So these three are extremely specific criteria. It's very objective. There is no subjectivity in this. Okay. Near their 52-week high, I will discuss tight base. This is a bit subjective, but this is very objective. Near their 52-week high means within a 20% distance from its 52-week high. So let's say a stock has a 52-week high of 100. Okay. So the stock current price should not be less than 80 because 80 is 20% below the 52-week high. So any stock which is within the 52, within 20% of the 52-week high, that should be on your radar. That should be on your watch list. Okay. So focus on the best stocks from the best industries in confirmed stage 2 uptrends near their 52-week high and forming tight bases. So when a stock goes up, forms a consolidation or a basing pattern, again it goes up, again forms a consolidation or a basing pattern, again it goes up, again forms a basing pattern. So the basing pattern, the tighter it is, okay, the better is the setup. Okay. The looser it is. Okay. If it's a tall base, okay, weak base, it's not a high probability setup. So I have made videos on how to identify high quality bases. Okay. Again, you will find that video in the stock filters list as well. So the tighter the base on the right side of the chart, the better is the setup. Okay. So let me repeat the formula again. Focus on the best stocks from the best industries and in confirmed stage 2 uptrends, forming tight bases near 52-week high. This much criteria is enough to swing trade a particular stock. Okay. It should form a proper buy point. Now, how to identify the proper buy point? What are the things to look for on the chart? I have made a ton of videos on that. You can check it on my YouTube channel. But the stock relative strength should be 80 or more. Those are the best ones. Sometimes people go with relative strength of 70 or more. But if you really want to be in the best, okay, you don't want to play around with any other stock, then even relative strength of 80 or more is enough. Because imagine there are 5,000 stocks in the, let's say, Indian market. There are 5,000 stocks in the Indian stock market. If you pick stocks with a relative strength ranking of 80 or more, you are looking at the top 20 percentile. That's 1,000 stocks. Okay. You are looking at 1,000 stocks. Okay. I think that should be enough. Okay. If you're not satisfied even with 1,000 stocks, then your thinking is not right. Okay. You're compromising on your standards. So stocks with a relative strength of 80 or more, industries with ranking between 1 and 40. I would prefer that the industry ranking is between 1 and 20. I would call them the best of the best industries. Okay. So stock relative strength 80 or more, industry ranking between 1 and 40, stage 2 uptrend, the 50-day above the 150-day, 150-day above the 200-day, and the price is above the 50-day. Price within 20% of their 52-week high and a tight base on the right side. Okay. This is enough. to swing trade a particular stock. Now let's come to position trading. Now, before I talk about position trading, let me give you some tips on swing trading. After this criteria is met, when you buy the stock and it starts to move in your favor, okay, be quick to protect your capital. Okay, be quick to start moving your stop loss up and up as the stock goes up. Okay, after you buy, the stock can only do two things. It will either come down and hit your stop loss, or it will start going up. Or sometimes it might come down and you will get an opportunity to exit the stock even before it hits your stop loss. Okay. So instead of taking an 8% loss, you could end up taking a 4% loss, which is fantastic. The more you limit your losses, the better will be your trading performance. Okay. So if it starts to come down, you know how to manage your risk. Okay. But if it starts to go up, okay, that is where your trade management skill comes in. Where, how do you move your stop loss? At what level do you keep your stop loss? How much room are you giving to the stock to fluctuate? That's a skill. That is where trading becomes an art rather than a science. Till here, trading is a science. After you get into a stock, it really becomes an art. Trade management is not science, it is an art. Okay. Now, coming to swing trading, the same rules apply, but you need to look at some additional things. Remember the main difference I told you about between swing trading and positional trading? Well, in a positional trading, okay, you want the stock to remain above the 50 days simple moving average line for 6 months, 1 year, 2 years, maybe 3 years. Okay, there are stocks I have seen that have gone up 4 times, 5 times, 8 times. Okay, it has created 8 bases and still never closed below the 50-day simple moving average or the 10-week moving average line on the weekly chart. It has happened. Okay, there are many stocks like that. That is the reason why I say for a positional trading stock, if that stock closes below the 50-day simple moving average on high volume, that is not, you should be out of that position. Okay, that is not, that stock is no more a stock which can be held as a position. Okay, but as long as the stock is above the 50-day simple moving average, you are doing well. And a stock could go up 200, 300% without ever closing below the 50-day simple moving average. Okay. Now, you have additional 3 criteria here. Everything remains the same criteria here, but you add 3 more filters because the for positional trading, you could bet more. You could put more money at stake. For swing trading, let's say you take a position size of 5%, a normal position size. But for positional trading, you can go to up to 10, 15, or even 20, 25%. Depends on your experience. But the more position size that you're taking, the more risk you're taking. So to compensate for the risk, you need to stack the deck in your favor, which means you need to have the fundamentals and the technicals in your favor. This is what technicals is all about. Now we'll talk about fundamentals. Why do you think a stock will remain above the 50-day simple moving average for 6 months, 1 year, 2 year, 3 years? Well, there are only 3 reasons: sales growth, earnings growth, return on equity. If behind every stock, there is a business. And as long as the business is doing well, as long as the company is doing well, the stock will continue to perform. Okay. Imagine a stock which is showing good earnings growth, but that earnings growth is not supported by sales growth. Well, that business or that kind of those kind of numbers are not going to sustain. Maybe what is happening is the management is trying to cut cost, which is increasing, which is showing an artificial increase in the earnings growth. But ultimately, for a company to grow for a sustained period of time, you need sales growth as well. I have seen stocks where the earnings growth is 55% quarterly, but the sales growth is only 4%. That is not going to sustain. You need sales growth and earnings growth. Okay. Now I will give you a criteria, which is the Patrick Walker criteria, which will reduce the number of stocks that will come on your radar, but it will highly increase the probability of your success. So by good quarterly sales growth, what Patrick Walker means is that any stock which has a recent quarterly sales growth of 40% or higher. So you take, let's say, June quarter. You look at the June quarter sales growth, You look at the March quarter sales growth, you calculate the average. Okay, that average should be more than 40%. Okay, that is one criteria. Now, what do I mean by quarterly? So you have to compare the June quarter of this year with the June quarter of last year and calculate that growth rate. So look at the June quarter and the March quarter, recent 2 quarters, make the average. So let's say current June quarter sales growth is 70% and the March quarter sales growth is 50%. So the average is 60%, which is above the 40% criteria. So the minimum average should be 40% or more. Okay, that's the Patrick Walker's criteria. Patrick Walker is a veteran trader in the US market. He has developed this criteria. Okay, and I personally use the criteria to find the best of the best stocks. Okay, so 40% or more, the average quarterly sales growth for the recent 2 quarters should be 40% or more. Now, if that is not available, if the stock is not showing that kind of sales growth, then at least you should have a recent quarter earnings growth in EPS. Earnings means I'm talking about earnings per share. The recent quarter EPS growth should be 40% or more if this condition is not satisfied. Okay, so let's say June quarter, you compare the current year's June quarter with last year's June quarter, and if the growth is 40% or more, that stock should be on your watch list. Okay, so one of these conditions should be met, that is called as a best stock. If both are met, then I would categorize it as best of the best. Okay, and high return on equity. What do I mean by high return on equity? High return on equity means minimum 17% return on equity. This comes directly from William O'Neill and company. They have done extensive research on this. So in short, recent two quarter average sales growth 40% or more, or recent quarter EPS growth 40% or more, and high return on equity. Okay. Now, you might not get all the three in one company. Sometimes there is only earnings growth, but you don't get return on equity and sales. Sometimes you get these two conditions, but the return on equity is poor. Sometimes you get earnings and return on equity, but the sales growth is poor. So if there is a compromise in one of those factors, I would still consider the stock. However, if none of the three are in place, that stock should be rejected. And if all the three are in place, that's like an icing on the cake. Okay, you understand what I'm saying? So I'm categorizing stocks as best stocks, and within the best, I'm categorizing some as best of the best. Okay, so you look at the best stocks, but within that, there is this subset which I call best of the best, which means which means price strength of 90 or more, industry rank below 20, stage 2 uptrend, the 50-day, the 150-day, the 200-day, very tight base on the right side, price within 20% of 52-week high, recent quarter sales growth, recent two average sales growth quarterly is 40% or more, recent quarters EPS growth is 40% or more, and return on equity is 17% or more. Okay, what else do you want? Okay, that's a stock to buy. Okay, beyond this, there is no need to look at any other fact. There are hundreds of things you can check. You can pour over balance sheets. You can read the last 10 years annual reports of companies. You can do ton of research. You can watch YouTube videos, listen to conference calls of the company. However, those are the things that I recommend that you do after you have taken a position in the stock and it has started to go up, because on any given day, you might have 10, 15 stocks on your watch list. Okay. Do you have the time to check the business model and the balance sheet and the annual report of each and every company? No. In that case, you will fall into something called as analysis paralysis. Okay. Don't do too much analysis. This much analysis is enough, because there is enough research done by people like David Ryan, Patrick Walker, William O'Neill. There is enough research done which shows that these are the characteristics that make stocks go up. These are the main characteristics that make stocks go up 100%, 200%, 400%, 500%. Okay. So before buying, look at these factors. Sometimes I don't even know what business the company is in. But if it meets all of this criteria, I am interested in the stock. I will buy the stock. And once it starts to go up, then I start to take more interest in the stock. What is the company doing? Which industry does it belong to? What product does it sell? Who are the clients of this company? Why is the company growing? Are they doing share buybacks? Are they giving dividend? How much does the management own? Is there any other company trying to buy this company? Is this company being included in some index where a lot of fund flow can come into the stock? A lot of things are there which we can check. How much leverage does the company have? How much cash flow does the company have? Things like what is the capital structure of the company, the debt in the company. As I said, a lot of things can be looked at: profit margins, uh, pre-tax, after tax, operating earnings of the company, gross margin of the company. We can compare the company with its competitors within that same industry group. So all those kinds of things I will do on my spare time, maybe on the weekends or during the day when I don't have any opportunity to buy any other stock. I'll just study the company that I own. Okay. And the more I study it, the more my confidence grows. And if I know enough about the company and the company starts delivering what I expect it to deliver quarter on quarter, that gives me more confidence to stay in the stock. So that's high quality positional trading. This almost goes into the category of investing. Okay. You are actually investing. But pure play investors, they don't look at all these factors. They only look at the business of the company. People like Warren Buffett, Peter Lynch, they would not look at all these things. They would look at the business of the company. And their holding period could be like 5 years, 10 years, 15 years, 20 years, or even more than that. They would love to hold a high quality company for forever and just keep eating the dividends or the earnings. But positional trader, like 1 year, 2 year, 3 years, that could be the maximum holding period. But during that period, you get a multi-bagger, like 2 times, 5 times, maybe even 10 times before the base is reset and the company starts to uh, uh, go into stage 3 or things like that. But that's a story for some other video. But I hope this video has helped you. This is like a proper filter. It's like uh, it's you can call it a formula. Okay, just use this formula. It will keep you in the right stocks. It will uh, keep you away from the penny stocks and things like that. Okay, if you want to add some more filters to this, look at stocks which have average daily volume of at least 200,000 shares per day. Okay, that will keep you away from all the penny stocks. So you're only trading high volume stocks which meet all this criteria. This much filtering should be enough. Have one filter which gives you all the data. Okay, I would say filter these, use these filters, and these you can check manually on the MarketSmith page or whatever software you are using. Okay, because this criteria remains same for both. So use these filters, and whatever stocks you get, try to find if there are stocks which show characteristics of which you can hold on for a long period of time, where you can take a sizable position like a 10% of your portfolio with confidence. Okay, so I hope this video has been helpful. Please support this YouTube channel. Please like, comment. Okay, whatever you want to discuss, let us discuss here, so that the channel gets better reach. Okay, it reaches those people who truly need this information. I know there are a lot of traders out there who are struggling, not able to do well. Just watching this single video could be life changing for them. So please share this video, not for me, but for fellow people like you who truly are spending time trying to earn profits from the market. This video will help them uh, definitely. So please do your part. Please share this video. It will give this channel some reach, and it will give me the motivation to create high quality videos like this. Remember, this is like the most important video that you will ever watch if you are a stock market trader or an investor. The long only strategy people. I am not talking futures and options here. Okay, I am talking old school buying and selling of stocks. If you do that, this is the best video you will ever watch. Okay, thank you so much.